All righty, it's 12 o'clock. Happy Tuesday. Welcome to Money Talk Tuesday. This week's session is about the Public Service Loan Forgiveness, Everything You Need to Know 101, presented by Experience Your Wealth and TISLA. This is our little agenda here. We're going to go over the Office of Economic Empowerment, any disclosures, housekeeping, and then we'll introduce our speakers for today. About the Office of Economic Empowerment. The Office of Economic Empowerment is a department within the Office of the Treasurer and Receiver General of Massachusetts, tasked with supporting, advocating, and facilitating policies that empower all Massachusetts residents. Our programs serve women, families, high school students, veterans, and seniors. Our priorities include closing the wage gap, increasing access to financial education, improving college affordability, and investing in STEM careers and education. This is a Zoom webinar and will be recorded. The recording will be uploaded onto a public website for future use. This webinar is also being streamed live on Facebook. Any information shared through the question functions will be anonymous. Please note, however, the chat record is subject to public record laws and as such is not anonymous. For housekeeping, again, this is a webinar, not a meeting, so you will not be able to see other participants. You can use a chat feature to communicate to the host and our panelists. Also on that bottom bar, the Q&A will be available throughout the webinar. If you're watching this on Facebook, feel free to drop your questions in the comment section. And please complete the post survey so we can continue to improve our program. We have an exit poll, so if you are filling that exit poll out, disregard the survey. If you don't catch that exit poll at the end, we'll be sending the survey out via email. So make sure you're registered to get all of the links and that survey to help us keep doing these things and do them better. Next week, not next week, October 6th, we'll be having a money talk that is going over understanding and improving your credit score, presented by Citizens Bank. Again, that's October 6th at noon. You can register at the bit.ly included, or you can always email us at moneytalk@tre.state.ma.us. And without further ado, I'm gonna get ready to introduce our lovely speakers. First up, we have Betsy Mayotte, and she's gonna get us set up here. Hi, Betsy.
Hello.
And again, if you guys have any questions at all, please feel free to drop them in the chat or in the Q&A box, and we will get to them periodically throughout our talk here. Take it away, Betsy.
Okay, let me just share my screen and get everyone started. Good afternoon, everybody. Thanks for sharing your lunch hour with us. I love talking about public service loan forgiveness. I was really excited when I was asked to do this session with the Commonwealth and with Jake. So I'm going to be covering more than the high level of PSLF, definitely the basics. We have an hour, and Jake has some awesome information to share with you too. So there may be some areas of PSLF we might not be able to cover. I do encourage you to use the chat panel on Zoom to ask your questions. We'll be monitoring that throughout, and I will be taking a breath every now and then to see if there are questions along the way. And then when I'm done with the PSLF portion of it, Jake is going to talk about how to apply that on a broader level with your personal finance plan. So I want to tell you a little bit about who we are. TISLA stands for the Institute of Student Loan Advisors. That's a Massachusetts-based nonprofit whose mission is to ensure that all consumers, regardless of whether they live in Massachusetts or elsewhere in the United States, have access to free, expert, and unbiased student loan advice. So anyone can access our website. We have some really good plain English content on there, just about anything you'd ever want to know about student loans. But if there's something that you have questions about, you can email us through our contact us page. It's completely free. There's no registration requirement. We're not going to ask for your personal information beyond what we need to answer your student loan questions. We also have people that feel that they have disputes with their student loan servicers. We can evaluate your account to see if there really is an issue there. And if there is, we can help you figure out how to advocate for yourself to get that resolved. So our website is freestudentloanadvice.org. Now, getting into PSLF, which is one of my favorite topics. So listen, ultimately PSLF really has three main rules. So if you don't remember anything else about what I tell you over the next half hour or so, remember this. There's three key elements to PSLF. You have to do all three, and you have to do all three at exactly the same time. Those three elements is you have to make 120 eligible payments, which I'm going to define an eligible payment in a minute, on eligible loans, which I will also define, while working for an eligible employer. So again, all three of those things have to happen at exactly the same time. So you could be on an eligible payment plan and making eligible payments while working for an eligible employer, but if you're not making those payments on eligible loans, those payments are never going to count. And you can, switch that around. You could be making payments on eligible loans while working for an eligible employer, but if you're not on an eligible payment plan, it's not going to count for public service loan forgiveness purposes. It may count for what's called the TEPSLF, but it won't count for PSLF. So again, if you don't remember anything else, just remember these three things: 120 eligible payments on eligible loans while working for an eligible employer, all at the same time. Now let's get into a little more detail and define what an eligible loan is. Short answer, an eligible loan is a federal direct loan, full stop. Now a federal direct loan can be a subsidized or unsubsidized Stafford loan, it could be a graduate plus loan, it could be a parent plus loan, it could be a consolidation loan that's made at any point in time. Now, if your loans were made on or after July 1st, 2010, then it is absolutely, and it's a Stafford loan or a plus loan or consolidation, then it's absolutely a direct loan and therefore eligible. Where it gets confusing is that there actually used to be two federal student loan programs that were exactly the same except where they were different. Prior to 2010, there was another program called the Federal Family Education Loan Program. And actually the vast majority of federal student loans were made under that program at that point. FFEL loans, which is that Federal Family Education Loan Program, are actually not eligible for direct loans. And we're going to cover that a little bit more in just half a second. So just to recap, an eligible loan is a federal direct student loan. There are no other loans that are eligible for public service loan forgiveness. Now, these loans are not eligible for PSLF in and of themselves, but they are eligible if you consolidate them into the direct loan program, which is super easy to do. So this includes those FFEL loans that I was talking about a minute ago. So remember I said that the FFEL program and the direct loan program were exactly the same except where they were different. So both programs have Stafford loans, both programs have consolidation, both programs have graduate and parent plus loans. So looking at your loans and saying, oh, I have Stafford loans, I must be eligible for PSLF. That's not necessarily the case, especially if the loan was made prior to July 1st, 2010. If it was, you need to verify whether it's a direct loan or a FFEL. There's two ways to do that. You can either call and ask your servicer, or you can log on to studentaid.gov, which used to be NSLDS, and see what it shows as the lender. If it shows the lender as the Department of Education, as opposed to like Navient or Chase or who's a Discover, for example, then if it shows Department of Education as a lender, then you know that you have a direct loan. And again, if it was made after July 1st, 2010, then it's absolutely a direct loan. If you do need to consolidate your loans, because they're not eligible, they're either those FFEL loans or some of these other loans you see in front of you, Perkins loans, HEAL loans, which is the Health Education Assistance loans. You can do that at studentaid.gov, and it's a pretty easy process. But if you need to do that, you need to do it sooner rather than later, because any payments made prior to consolidation are not going to count for PSLF, and there's absolutely no way around that. So if you do have a FFEL or a Perkins loan and you need to consolidate into the direct loan program to get access to PSLF, you need to do it sooner rather than later. Loans are never eligible for PSLF, and they can never be made eligible for PSLF. That also includes loans you may have gotten through your state. Some states have state loan programs, such as New Jersey. Loans that you got directly from your school, which we call institutional loans, where the school is actually the lender, those could also never be eligible for PSLF. So to recap, an eligible loan is a direct loan. Certain other federal student loans can be made eligible by consolidating them into the direct loan program. Before we move on to what an eligible payment is, Jake, do we have any questions about what an eligible loan is?
I'm not seeing yet. We did have a question from a participant, but waiting on the 2 questions that she had, and then I will type in if those are eligible, if those are applicable.
Roger that. Thank you. Okay, so let's talk about what an eligible employer is. So here's the bottom line, and there's a ton of confusion around this. It doesn't matter what you do for a living. It matters who you work for. And where I see this most often is, say, people that work for the public school system. I think the vast majority of teachers in a public school system realize that they're potentially eligible for public service loan forgiveness. But the other employees at the public school system tend to not realize that they are also potentially eligible for PSLF. That includes the principal, the administrative assistants, the custodian, the cafeteria workers, the groundskeepers. Again, it doesn't matter what you do. It matters who actually is paying your paycheck. You do have to be full-time, and full-time is defined by your employer, but it can't be any less than 30 hours per week. Now, you can also work part-time for multiple eligible employers, and that can also count as long as you're working a total of at least 30 hours a week. Now, this is another area where I've seen a lot of confusion. So just to clarify, if your employer defines full-time as 40 hours a week, and that's your only employer, and you only work 35, then that employment would not count for PSLF purposes. However, in that same scenario, you're working for one employer for 35 hours a week. They define full-time as 40. You would just have to go and get another job at another eligible employer for just a single hour a week. That would bring you to a total of 36 hours, which is more than the 30 hours required if you're working for multiple employers. It used up until very, very, very recently, like within the last 45 days, you did have to exclude any hours that you did in a religious capacity. So for example, if you taught Sunday school, or if you worked for a church and part of your job was to give sermons or do other types of religious instruction, it used to be that you had to subtract that from your hours. So to use the example I used a minute ago, if your employer defines full-time as 40 hours, you work 40 hours, however, you spend 5 of those hours every week with religious instruction, you would have actually had to have worked 45 hours for it to count for PSLF purposes, because you had to subtract those 5 hours of religious instruction. But again, as of about 45 days ago, you no longer have to do that. The best way to verify that your employer is eligible, and also to keep track of your eligible payments, is to submit what's called the employment certification form. Now, to be very clear, you're not required to submit that at all until you've reached 120 payments. But that's a terrible, terrible strategy, because until you do that, you don't know for a fact whether your employer and your payments are eligible. So we recommend very strongly that you get in the habit of submitting your employment certification form every single year. Now, let's say you're 5 years into working for an eligible employer, and you've never submitted an ECF at this point. That's okay. You can do the past 5 years all at once right now. Again, you don't have to, but that's, man, you're someone who likes to live on the edge. I can't suggest enough how important it is to ensure that you're on track is by submitting your employment certification form on an annual basis. there's a couple places to get that form. Studentaid.gov has the form. Our website has the form, and the Fed Loan Servicing, which is the servicer that focuses on PSLF. They're the only PSLF servicer. They also have the form. Now, once you submit your first ECF, your loans are going to transfer from wherever they are now to Fed Loan Servicing, and they're going to transfer all your past history as well. That's another good reason to submit your ECF forms on a regular basis, because they have a much better track record accurately counting your payments if the payments were made to Fed loans than they do have counting payments that were made to prior servicers. They eventually get it right, but sometimes there's a lot of hair pulling and teeth grinding and profanity before they do. So again, getting to Fed loans and submitting your ECFs as soon as possible and on a regular basis is the best way to have to make sure you're progressing and that you have the least stressful PSLF experience that you can.
All right,
Now,
Beth, before we move on, we do have some questions I wanted to run by you. So there's going to be 3. So starting with the first one, the question is, my parents have Parent Plus loans that they have been paying. They have not applied for PSLF yet. When they do apply, will their previous payments be eligible?
so that's a mixed answer. That's a maybe. So Parent Plus, I'm so glad you brought that up. Parents Plus loans, that's another sort of education low point that a lot of people don't realize that Parent Plus loans are eligible for PSLF, but it's sort of a trick. We haven't gotten to the eligible payment section of my presentation yet. So spoiler alert. The only payment plans that are eligible for PSLF are a 10-year standard plan. Now let's put a pin in that for a second, or an income-driven repayment plan. Now, if you make all 120 payments on a 10-year standard repayment plan, you're going to pay the loan off, because a 10-year standard plan is 120 payments. So ideally, to take advantage of PSLF, if you have a Parent Plus loan, you need access to an income-driven plan. And the only way to get that is to consolidate the loans. Even if you already have a direct Parent Plus loan, if you consolidate, you can then get access to what's called income contingent repayment. So to answer this user's question, if they're already on an income-driven, if they're already on ICR, or they've been on a 10-year standard plan, they submit their employment certification information now, absolutely those payments will count. If they need to consolidate to access income contingent repayment, then those prior payments are not going to count, because remember, any payments made prior to consolidation don't count. But there is sort of a life jacket here, and I'm going to talk about it when we talk about the TEPSLF program. So Jake, let's make sure I get back to that question when we get into the TEPSLF, all right?
Sounds good. And I'm going to be answering other one-off questions along the way, but anything that I think is applicable for everyone else, I'll interrupt you and then ask that live.
Sounds good. All right, so let's keep going with what an eligible employer is. So most of what an eligible employer is pretty black and white. If you work for the government, you work for an eligible employer, and that's federal, state, local, or tribal. Now remember, it doesn't matter what you do, it matters who you work for. So contractors are not government employees. So you might walk into, well, pre-COVID, every day you walk into a government office, you sit at a government desk, you answer a government phone. Your business cards might even reflect that you work for on behalf of a government entity. But if it's a private entity that issues your paycheck and is the one that has the ability to hire and fire you, then unfortunately you don't have an eligible employer. And there's no way around that. I shouldn't say there's no way. The way around that is to try to get the government entity to hire you outright. But I have run into a lot of contractors that, by all appearances, it looks like they are government employees, and they really are not. But being a government employee includes serving in the military full-time, being in the Peace Corps, or being in AmeriCorps. All that counts as working for a government employer. The other part that's pretty black and white is if you work for a 501c3 nonprofit. If you work for a 501c3 directly, then you work for an eligible employer, full stop. Now, how to know if you work for a 501c3? It's almost certainly on your company's website, but I guarantee you your HR department, your legal department, and your finance department will all know off the top of their head whether you're a 501c3. So again, if you're a 501c3, and that's who issues your paycheck, then you work for an eligible employer. I make that designation because I see in a lot of hospitals and other larger nonprofits that there's actual multiple legal entities within the organization. There'll be the nonprofit arm, which is a 501c3, and then there'll be a private arm that's a private employer. And I've run into cases where, say, a doctor works for a hospital, but it just so happens that their paycheck is issued by the private entity. And unfortunately, in that scenario, that employment doesn't count for PSLF purposes because they aren't actively employed by the eligible employer, which would be the 501c3 arm of that hospital. Now, where it gets tricky are other nonprofits that could potentially be considered eligible employers because this is not black and white. So if the employer is, excuse me, not a 501c3, but their whole primary purpose is one of the bullet points you see in front of you, they could be considered an eligible employer. So for example, a 501c9, if their primary focus is public interest law, then that's potentially an eligible employer. Where it gets tricky is sort of there's two places where it gets tricky. One, determining whether that one of these bullet points is actually their primary focus. And two, these bullet points are not as transparent as they appear. And public interest law is a perfect example of that. There was a court case 3, 4, 5 years ago now, where employees of the American Bar Association had been submitting ECFs for a couple of years. They'd been approved. And at face value, that makes sense. One would think that the American Bar Association would fit the definition of public interest law services. However, if you dig a little deeper, the definition of public interest law services is actually an entity that receives at least part of their funding from the government. And the ABA didn't receive any funding from the government. So in reality, the ABA was actually not an eligible employer. So since that, it actually ended up going to court, and the court agreed that the ABA was not considered an eligible employer for PSLF purposes. Now, before anybody panics thinking, oh my God, I have 9 years of approved ECFs under my belt, they could whip the rug right out from under me. I can assure you that, especially since the ABA case, they've added a lot more checks and balances. So the cases of a false positive, so to speak, are significantly reduced. And again, something like 90 or 95% of borrowers that are pursuing PSLF work for either a 501c3 or a government entity, and those are black and white. It only gets a little gray when you're looking at these other non-501c3 nonprofits. Any questions about eligible employment, Jake?
Not that I'm seeing. There's a lot of different questions that I'm doing my best to answer to all of those, but as of that, actually, yes, one just came in. If you were employed with an eligible employer and have left your position, can you still claim that time, or does that time expire?
Oh, I'm so glad you asked that question. So the short answer is absolutely you can claim that time, but you just reminded me of another really, really, really good reason to get in the habit of submitting your ECFs sooner rather than later and on an annual basis. So up until fairly recently, for we old people, it was more common than not that organizations and corporations kept records forever. So, you know, they could go back 5 years, 10 years, 15 years, even 20 years to look at records. But these days, the legal advice that's given companies is to get rid of stuff as soon as possible. And that's for liability purposes. Protecting personal information is a huge, huge deal right now. And if you destroy the information, you don't have to protect it anymore. So I would hate to see a borrower who worked for an eligible employer, say 8 years ago, they went back now to get their ECF certified, and the employer says they can't do it because they destroy records after, say, 5 years. So if you can get your ECF certified, it will absolutely count. It doesn't, the only way it expires is if you consolidated the loan after that employment period. But you should still try to get that ECF filled out ASAP for the reason I just explained. So the types of employers you see in front of you can never be eligible for PSLF. That's labor unions, partisan political organizations, for-profits, or not-for-profits that aren't 501c3s and don't fall under one of the categories that I had on the prior slide. Any other employment questions?
Yeah, one more just came in. The question is, I worked for one of the 501c3s from 2012 to 2018, and then started working for another 501c3 from 2018 to present with no gaps. So 8 total years full-time work. She did not know about PSLF. Can I apply? And what would I need from my previous employer?
You would just need both employers to fill out that employment certification form for the period of time that you were employed there. So it's not too late, assuming that you were eligible otherwise. You had direct loans during that whole period and you were making eligible payments during that period. It's interesting that she said she said there were no gaps. Even if there was a gap, it doesn't matter. That was actually a great transition to this slide about the employment. In addition to working full-time for an eligible employer while you make every one of those 120 eligible payments, you also have to be working for the eligible employer at the time you apply for forgiveness and at the time the feds review your forgiveness application. Now that third bullet is fairly new guidance. And all I could think of when they came out with it was some poor person who hates their job, but they plug along because they want PSLF. They hit their 120 payments, they submit their application, and then they rage quit in a dramatic way, only to end up getting it denied because they weren't working for the eligible employer, 45 days later when the feds reviewed their application. So if you are in that unfortunate position where you don't like your job and you're only there for PSLF, which hopefully doesn't apply to anyone on this call, and you have this dramatic rage quit scenario in your head, don't pull the trigger on that unless and until you get your approval letter for PSLF, and then you can stand on the table and quit and dance your way out the door. But don't do it until you get that approval level. Now, you don't have to work for the same employer for the entire 120 payments. You don't have to have consecutive eligible employment, and you don't have to have consecutive eligible payments. You can have a 12-year gap in between eligible employment. The only thing that can wipe away prior eligible payments or employment is if you consolidate. All right, so let's talk about what an eligible payment is. Excuse me. An eligible payment is one that's made on time, and that's defined for PSLF purposes as being within 15 days of the due date. So if your due date is the 1st of the month and you make that payment on the 16th, it's not going to count for PSLF purposes. Only payments made on or after October 1st of 2007. Any payments you make while in default are not going to count. They do have to be made while you're working full-time for an eligible employer on a direct loan, but it doesn't matter who makes the payment. So let's talk about Parent Plus loans again. There's a lot of scenarios where the student for whom the Parent Plus loan was taken is the one actually making the payments. That's fine, as long as it's the parent borrower who is actually working for the eligible employer. So again, it doesn't matter who makes the actual payments. Now, we're in a super unique scenario. And when I say unique, like I've been in the student loan industry since the earth cooled. I've been through lots of disasters, 9/11, Katrina, and so on. And I've seen the Department of Education and Congress and the administration during those times have some pretty robust relief available to borrowers. I've never seen anything like this. So between March 13th and as of right now, December 31st, although it could be extended, don't hold your breath, but it could be extended. If you have direct loans, you're not required to make any payments right now. But if you're still working for an eligible employer, these months are going to count for PSLF purposes. Also, if you're pursuing forgiveness, maybe you're not pursuing PSLF, but you're pursuing forgiveness under an income-driven plan, these months, again, will count for PSLF. So I know a lot of borrowers that they have a lot of anxiety around their PSLF eligibility, and I understand why, and they've been making payments anyway. Stop it. If you're one of those people, you're literally throwing money away. You're not going to get PSLF any faster. You're not going to get any extra counts. You're literally taking money and pushing it down a sewer grate. So if you're one of those people, you need to call and ask for that money back, and they'll send it to you. They'll actually send it to you pretty quick. And you will still be eligible for those 9 months worth of payments between March and December. Again, assuming that you've been working full time for an eligible employer. Use that money, put it in a savings account, add it to your emergency fund. If you have private loans, use it to pay off the private loans. But you should, if you're pursuing PSLF and you have a good shot at getting it, you should not be sending an extra penny towards the program. Hedging your bet, so to speak, all it does is steal money from, you're just stealing money from yourself.
Betsy, we do have some questions, a few applicable to what you're just mentioning, and then also some various ones that I'm going to pull in. So one question came through: what is the process for getting a refund on any PSLF payments made since March 13th?
Call them on the phone or send them an email. Super easy peasy. And just say, I'd like a refund for payments made between March 13th and today due to COVID. The end.
And then another question we have: what happens if you pay your student loans on the 1st and the 15th of the month in order to expedite your payments? My guess is that question is more related to qualifying for public service loan forgiveness and the payments as opposed to the suspension right now.
You have to make a full payment within 15 days of the due date for it to count for PSLF purposes. So if you're in that scenario, if your due date is the 15th, then you should be fine. But if your due date is the 16th, then those payments aren't going to count. And by the way, if you're pursuing PSLF, there's no rhyme or reason to sending your payment in 2 pieces like that. You're not expediting anything. That's a strategy some people use if they're trying to aggressively pay off their student loans themselves. But doing that for PSLF, and if you're pursuing PSLF, there's no value to it.
And another question we had is, this person's worked as a Social Security disability attorney for over 10 years. The attorney's fees have come from the Social Security Administration. Why is she not eligible?
Well, I don't know for a fact that they aren't, but it sounds like they don't actually get their paycheck. They're not considered an employee of an eligible employer, which would be this, in this scenario, the Social Security Administration. This attorney would actually have to be an employee of an eligible employer, and it sounds like they are not, even though their fees come from there. They're a contractor or a vendor.
And then another question was related to the one.
Wait, I'm sorry to interrupt. Something to consider for that particular attorney, though, if they have a private practice, is they might want to see if they're eligible to create a 501c3 for their business. That, and the business would receive, the 501c3 would receive the fees from the Social Security Administration, and then the 501c3 would pay the attorney, and in that scenario, they would be eligible. But if they're not already, assuming they're self-employed, if they haven't already done that, then they're not eligible employment. Remember, it doesn't matter what you do. It matters who issues your paycheck, like who issues your W-2. And so sorry about the interruption. I just thought that was important for this person.
No, no way. Another question we had is, I'm not sure if you hit on this already, but the question before about making 2 payments in a month, this person was making full payments on the 1st and the 15th. So can you talk about that a little bit? And I know sometimes loans can get into the paid ahead status and what that means for public service loan forgiveness and the risk there.
So the paid ahead status isn't as risky as it used to be. There's actually a fairly recent change. First of all, so the person that's pursuing PSLF and making 2 full payments a month, stop it. You're not going to get PSLF any faster. You can't get it any faster. It's going to take you at minimum 120 months to get PSLF. So you're throwing money away. If you're doing that because you're not 100% certain you're going to get PSLF, then I still say stop it. Take that second payment and bank it. And if you end up leaving eligible employment or something else changes where you're not going to get forgiveness under PSLF, then make a lump sum payment at that point. You are doing yourself no favors and you're harming yourself financially. But let's talk about paid ahead status. Until fairly recently, within the past couple of years, if you were in a paid ahead, I don't want to get this to get too complicated, and I don't want us to run out of time either, Jake. But if people want more detail about this, they can email me. But effectively, the way the regulations work, if you pay more than your monthly payment and don't tell them differently, they're required under regulation to push your due date ahead and apply that money to a future date. Because of that regulation, if people paid extra, such as the person that submitted this question, then, let's pretend COVID wasn't happening and everybody was making their payments. You made a double payment in September, you wouldn't be due for a payment until November. Up until the last couple of years, even if you made a payment in October anyway, it wouldn't count for PSLF purposes. They have since changed that rule. They did it quietly, but they changed the rule. As long as you make a full payment every month, and by a full payment, meaning if your income-driven plan payment is $50, you pay $50 every month that you make a full payment of $50 within 15 days of the due date is going to count for PSLF. Now, your bill might actually say 0 because you're paid ahead, or your bill might say $25 because you're paid ahead. But if your actual payment under your income-driven plan is $50, you make that $50 every month. The other thing that has changed literally within the last couple of weeks is the lump sum payment issue. With some small exceptions with people that were in AmeriCorps or got payments through the Department of Defense, you couldn't make a lump sum payment and have it count towards future months. But they have changed that. So if you wanted to, let's say your payment was $100 a month and you just couldn't be bothered with paying your student loan all year. So in January, you sent a payment of $1,200. Now they will apply that from January through December. They won't apply it for more than 12 months. If you sent $1,400 in January, it would still only count January to December. But again, you're not going to hit PSLF any quicker, because in order for those payments to really count, you have to be working full-time for an eligible employer over that upcoming 12 months. So that's a change that's happened. They were really super quiet about it within the last couple of weeks. So ideally, the bottom line is, unless your employer is making lump sum payments on your behalf to your student loans, there's no good reason to pay extra at any point. Pay your minimum student loan payment, pay it every month, pay it on time. Otherwise, you're just making things complicated for yourself. How's that?
That's great. We have a few other questions, but just in the interest of time, I think we should move on, and then we can always circle back at the end.
Yeah, I'm happy to hang out if everybody else is when this is, but Jake has some awesome stuff and I want to make sure we have plenty of time for it. So I'm going to whip through the last couple slides. Maybe we'll take like one more question, then we'll move on to Jake. Does that sound good?
Sure.
Wait, what time is it?
One question is, does that new paying ahead rule apply retroactively?
It does, but only for payments made to Fed loans. If you were in a paid ahead status at your prior servicer, they're still not going to count it. I'm super pleased with, as an aside, I'm super pleased with this policy decision. Quite frankly, I don't understand how they can do that on the way the statute is written, but I'm not going to be the one to push back on it. So, all right. So an eligible payment plan for PSLF purposes are a 10-year standard plan, which I explained. If you're on that the whole time, you're going to pay the loan off anyway. Income-based repayment, of which there are actually 2 iterations of income-based repayment that have revised pay-as-you-earn or repay, income contingent repayment. As a reminder, ICR is the only income-driven plan that Parent Plus loans can access, and they can only do it by consolidating. You don't have to be on the same plan for all 120 payments, and these plans only count if they're made on direct loans. The FEL program also has an IBR plan. So I've seen a lot of people tripped up on that. They think they're fine, they're on IBR, they're working for an eligible employer, but it turns out they had FEL loans instead of direct loans. Now, super fast because of time. So listen, to be frank, some of the servicers did a terrible job between, say, like 2008 when PSLF was signed into law and as late as like 2012, 2014 about the information they were giving borrowers about PSLF. So there was a lot of borrowers, particularly borrowers that had consolidated, that were incorrectly told that the payment plan they were on counted when it didn't. So in recognition of that, Congress created the TEPSLF. The TEPSLF, what it does is it's sort of a Hail Mary for people that were on the wrong payment plan. Now, you still have to have direct loans. You still have to be working for an eligible employer. None of those rules change. But if you were making payments under a standard consolidation plan, a graduated repayment plan, or an extended repayment plan, those payments would potentially count. You still have to make 120 payments. They still have to be on time. Here's how it works. And this rule is terribly written and stupid complicated. I've talked to some staffers that worked on it, and they admit it's a case of, you know, if you're wondering what the heck, why the heck did they write it this way? It's a case of too many cooks spoiled the soup. But your 12th to last payment, as well as your last payment, has to be at least as much as you would have paid under an income-driven plan. So for example, let's say you've been on a standard consolidation plan and your payments have been $300 a month and you've made at least 10 years worth of them. If you go to the calculator on my website or the one on studentaid.gov and punch in your numbers, and it shows that the lowest payment you could get under either IBR, repay, pay-as-you-earn, or ICR is $500 a month, then say this month you would pay $500, you'd pay your regular payment. Again, we're pretending COVID doesn't exist. So September you would pay $500. The next 10 months, 11 months, you would pay the $300. And then next August you would pay the $500 again, and then you would apply for the TEPSLF. If that's too confusing, you can just get on an income-driven plan for 12 months and then apply for the TEPSLF. I have this written up in plain English on my website on the forgiveness page. It's towards the bottom of the PSLF page. So if you're kind of going, what did she just say? I strongly recommend you go and read that. I also have, to request TEPSLF, you actually have to write an email, and I have a drafted email. You can just copy and paste and use that. There is a limited amount of money for the TEPSLF. It's on a first come, first served basis. How long is it going to last? I have no idea. At least a few more years based on how much has been spent so far. But if you're just starting this process, you should be pursuing PSLF. If you have, you know, you should be getting on an income-driven plan now. If you have anything less than, say, 5 years worth of payments under your belt, you should be getting on an IDR now and not count on the TEPSLF. We've sort of already talked about how to apply. You have to submit 10 years worth of employment certification forms. Preferably you're doing that on an annual basis. And then after you've hit 120 payments, you submit your actual PSLF application. If you make more than 120 payments, they will send you a refund. I actually just had someone today who successfully got the TEPSLF, and they're getting a check for $2,900 in the mail, and they are very excited about that. Here are the resources that I talked about along the way that are good resources for the things that we talked about. So, and with that said, Jake, unless there's like one last question you want to ask before we move it on to you, then I'm going to move it on to you.
Yeah, I think just in the interest of time, we'll make that switch.
Like I said, if you have PSLF questions, I'm willing to hang around after. And if we still run out of time, you can always email us for free at freestudentloanadvice.org.
I do also want to pop on here and just remind folks that we are recording today's session and that it will be available as long as everybody who's here is registered. You still have time. You can go into our Facebook event, or I'll put the link in the chat. So make sure you get the recording and all the links that we discussed today. They'll be available in the next 24 hours.
Well, I know we're getting a little short on time, but I'm going to wrap up by talking through some financial planning strategies. So if you are pursuing PSLF, how do you balance this with your other financial priorities? I'm sure some of you have seen that I've been responding to messages the best I can, but real quick. So my name is Jake Northrup. I'm the founder of Experience Your Wealth. So we help travel-loving young families that have student loans figure out what's the right balance between paying down your loans, investing for the future, but also experiencing life now. So I'm completely independent, no sales, annuities, no insurance, anything like that. Just charge flat fixed fees and helping people understand the ins and outs of different programs, but also how that is factored into their life as well. All right, so moving on now. So when you are pursuing PSLF, so Betsy talked about the structure of it, and I know you're probably thinking it's complicated. You might have seen the stats where 99% of people have been denied for PSLF, but to be frank, a lot of the people didn't have a chance in the first place. So as long as you have the right loans on the right repayment plan at the right employer, this is going to be focusing in on how does this factor into your other financial goals as well. So, you might be thinking this is a lot of work. Why should I pursue this? And the answer is it can truly save you tens of thousands of dollars down the road. So this is actually a chart that I put together for one of my clients who had $415,000 of student loan debt from med school. And based upon his income projection, he would only pay actually $250,000 towards his loans, and the remaining amount would be forgiven. So that's $175,000 value for it. So thinking through, and I think it's helpful for you to know, what is that dollar value for you pursuing this, right? And I know sometimes it can feel struggle to keep up with the record keeping or being at your job. So just thinking through and say, hey, what's that value? And is that aligned with what's most important to me? So with some proper help, you should be able to put together a few scenarios showing income levels, repayment plans, so you can make the best decision for your loans and your path. So when you think about repayment plans, so Betsy talked about which ones are eligible, but the name of the game, as we mentioned, is to pay as little as possible towards your student loans, right? So the lower you pay, the higher the value of public service loan forgiveness, because then more is forgiven after those 120 payments are made. So if you're single, you very likely want to select Revise Pay As You Earn. So you're eligible for repay, if you call it, when you have direct loans, which is a requirement of this program. And repay takes your income and subtracts 150% of a boundary line and then multiplies it by 10%. So think of it as your monthly income minus some deductions times 10%, and that's your repayment amount. There's also an added bonus where if your payment amount is less than the interest that accrues, the government will actually pay 50% of that for you. So if later on you decide to change repayment plans or do something different, your loan balance won't be as large. So if you're single, you likely want to use Revise Pay As You Earn, but that changes if you are married. And this is where student loans can get pretty complex, because an interesting planning strategy is to file taxes separately. So you can exclude your spouse's income from that repayment calculation. So this is something that you would likely want to work with a financial planner or accountant on, but it can save you a lot of money. Now, where it gets tricky is with revised pay as you earn, even if you file your taxes separately, spouse's income is included. So you also need to have the right type of repayment plan if you are filing taxes separately. So that's where either income-based repayment, also called IBR, or pay as you earn are probably the repayment plans that you want to look at that point. But unfortunately, not everyone is eligible for pay as you earn. So you couldn't have had student loans prior to October 1st, 2007, and you had to borrow after October 1st, 2011. So it's a two-pronged test. So if you don't meet that criteria, you're probably eligible for income-based repayment plan. But this is where it makes sense to get some help or get someone to take a look at it. So revised pay as you earn, if you're single, most likely makes sense. If you're married, you want to look at filing taxes separately and either going with pay as you earn or income-based repayment plan.
Hey, Jake, someone
Yep.
just asked an awesome question. Do you mind if I ask you for the whole group?
Sure.
So their question is, so the way they word is if you're married and both of you are pursuing PSLF, for your individual, because both spouses have loan debt, how does that impact your repayment amount? Do they consider both sets of loans? Do they consider both incomes? I think what this really applies more to how do they determine your income driven plan amounts?
Yeah, so it's a great question. And I'm actually
Told you.
Sorry, what were you saying?
I said, told you it was a good question.
Yeah, and I'm actually working on a client scenario right now in terms of two people that work in a nonprofit. They both have loans, they're both pursuing it. So it is a bit complex in terms of if you file taxes jointly, there's essentially this one payment that's calculated for your family. And then the loan servicers take the proportionate amount of each person's student loans and multiplies that. So then a payment amount is calculated. Now, let's say one spouse has a much larger income than the other spouse, then you might want to look into still filing taxes separately. So if you file it separately, what I talked about before, that proportion amount doesn't actually play into it. So I don't want to go too deep because it is pretty complex when you get into that. And I don't want to, just in the interest of time, but at a high level, if you file jointly, your household income is included, calculated at household level, and then proportion amount goes towards your student loan payments. But if you file taxes separately, it's just based on your income amount and not your spouse's, as long as you're not on revised pay as you earn.
Thank you.
Yeah, absolutely. And someone might think like, wow, that was complicated, but this is an example that's going to show the numbers and the savings of it. So let's say that you have $100,000 of student loans, you earn $50,000 and your spouse earns $150,000. And let's say that you have two kids as well. So let's say that you are on revised pay as you earn. And remember, this counts your spouse's income regardless of tax filing status. So this would take the full $200,000 household income and then subtract the poverty line deduction, and that would equate to about $1,300 a month of student loan payments. So that's if you're on revised pay as you earn. Doesn't matter how you file taxes because both spouses are included. But let's say you attended this webinar and you're saying, hey, I don't want to do that. I might file taxes separately, and you choose pay as you earn. That would only take your $50,000 of income. Your spouse's income would be totally excluded, and your payment would only be $89 a month, right? So you can see the power here where that's almost $14,500 difference of total payments going in. Remember, the name of the game with public service loan forgiveness is pay as little as possible. So this strategy can save you tens of thousands of dollars, but you gotta be sure that you're doing it right. So there's also other ways for you to lower your taxable income besides just filing taxes separately. Number one, you might be able to save into any pre-tax accounts. So if you have an employer 403B, traditional IRAs, things like that, You might want to choose pre-tax contributions, which lowers your called adjusted gross income, which then lowers your student loan payment. I'm usually a huge fan of Roth accounts when you're young, especially because you get tax-free growth on it. But if you are pursuing public service loan forgiveness, I would definitely consider using pre-tax contributions as opposed to Roth so that your monthly payment goes down. Another way is to save into what's called a health savings account. So you can only save into this if you're on a high deductible plan. But if you're single, you can put up to $3,550 in a year. And if you're married, a little over $7,000 a year. And that goes in pre-tax. And the real trick is actually to, instead of spending it, you keep it and invest it. So you put it in pre-tax, you invest it, it grows tax-free. And then later on, you could actually take it out tax-free too, as long as it's used for a qualifying reason. So financial planners nerd out for it because it's the only account with triple tax advantages. But also you get that front tax deduction to lower your student loan payment, which is really helpful. And then lastly, if you're covered by an employer, you might have something called a flexible spending account. So unlike the health savings account, this is kind of like the use it or lose it type account where you can put money in to cover things like co-pays or other things. And it's a big reason why, I don't know if you noticed, but everyone gets new glasses in December because they have money left on their FSA and they need to spend it. Remember, the name of the game, lower your taxable income. And especially if only one spouse is pursuing public service loan forgiveness, you might want to load up on that spouse's pre-tax contributions, right? So in other words, you might want to put more money in his or her 403B, IRA, and use the other spouse's income to help pay the day-to-day expenses. So you can see where you can get creative in terms of when the payments come in. So I know we're coming up on 1 o'clock, but I'll stop there and see if any questions came in, Betsy.
Nope, they've gone quiet on us.
That lunch hangover is starting to hit. Well, I think this is a really important slide because we talked about pursuing public service loan forgiveness, but a question that I get a lot from clients is, what if we want to do something different, right? And I always tell people that your life should drive your student loans. Your student loans shouldn't drive your life, right? So you don't want to feel handcuffed to a job you don't like just to receive loan forgiveness, right? If you're a year or two away, you might want to stick it out depending on the dollar value. That goes back to the point earlier of understanding what's that value of staying where you're at. But if you're at the beginning stages and you're thinking, hey, I could stay here for a while, that'd be miserable, it's not worth it, right? You can always figure out something different. So depending on your repayment amount, your student loan balance might grow as long as the interest charge is greater than your payments. It depends on your income amount, depends on your student loan balance. But there is another possible forgiveness route called actually taxable loan forgiveness. So I have had some clients that started towards public service loan forgiveness and they decided to change gears later on. So that could actually result in other types of forgiveness, but it's very different in terms of it's taxable. And that's what I'm going to go to on the next slide real quick. So this taxable loan forgiveness, so if you started at a nonprofit, you got a job offer to go somewhere else, or you're saying, I'm not really liking my job now, I want to try something different. Taxable loan forgiveness occurs of 20 to 25 years on an income-based repayment plan. And if there's a balance remaining after 20 or 25 years, as I mentioned, that balance is forgiven, but it's taxable under current tax law. It might change later on, but who knows? So unlike public service loan forgiveness, that forgiven amount is tax-free. This one is taxable. It's something called the tax bomb, right? So I've had a lot of clients pursue this, especially if their loan balance is greater than their income. And it's pretty unique in terms of, a certain year where your loans would be forgiven, your income is going to be high in that year. So to be frank, I have a bunch of clients taking a mini sabbatical or retirement in like 2035, 2036 to lower their income and celebrate their student loans being forgiven, because it actually saves them $10,000 to $20,000 of student loans. That's where I nerd out, because I'm able to understand where someone's life wants to go and then relate that to their student loans. I'm going to skip this in the interest of time, but similar to the public service loan forgiveness, it's helpful to know, what's the dollar value compared to paying down my loans quickly or doing something else if you did go down the route of taxable loan forgiveness and shift gears. So then wrapping up before we get into some questions, I always like to wrap these up like, what should you remember? What should you take away? So number one, remember during the COVID period, do not make any payments towards student loans if you're pursuing public service loan forgiveness, right? So the payments count towards that clock as long as you're still full-time, you're earning credit. So as Betsy said, you don't want to be throwing money away. Number two, submit your employer certifications annually to track your progress. You don't want to be at the end of the 10 years and be surprised that you had the wrong type of loans or wrong type of employer. So you definitely want to do this at least annually, so you actually see your progress getting closer. Third, if you had Parent Plus loans, you do need to consolidate those initially and apply for income contingent repayment to be on that income-based plan so that those loans benefit for public service loan forgiveness. Number four, understand the dollar value of PSLF, but don't feel handcuffed, right? So I strongly believe you want to be happy in your life, working something you're passionate about, and don't just go somewhere for 10 years that you're miserable at to get your loans forgiven. If you are married, definitely explore the scenario of filing taxes separately when pursuing public service loan forgiveness, but it is pretty complex in terms of certain deductions you lose. There's strategies where you could actually amend later on, but it gets a little too in the weeds. And then lastly, take advantage of any pre-tax accounts. So 403Bs, health savings accounts, IRAs, anything that you can do to lower your taxable income, thus lowers your student loan payments. And before we jump into any questions, just wanted to put in here our contact information. So if you wanted to keep in touch with me, you can check out my website, www.experienceyourwealth.com. As I mentioned, I work with young families with student loans. So if you're looking for more hand-holding and something that you want to integrate your life with your student loans, I would be a good fit for that. Betsy also offers free support if you're looking more for in the weeds of in the student loans, understanding are you qualified or not. And then we also have some resources here as well.
Jake, I have someone that says that they asked a question during my presentation about her dad's potential retirement, and you said you'd go over it during your presentation.
Yes, thank you for that. So so the question was, someone's dad is a few years away from retirement, but they might also be close to public service loan forgiveness. So I think within that regard, it's challenging to say, what's the right path without understanding his life a bit more. But I would figure out how close is he to public service loan forgiveness, and then have that decision help inform how long he wants to keep working for. So if he did retire and he was, say, retired next year and he was 3 years away, he would only get 8 years towards public service loan forgiveness, and he would need to find something else, working in a nonprofit, still having those loans in order to be eligible for the public service loan forgiveness. So I think it really factors into, what does he want to do with his life, and is it worth it to stay working for an extra 2 years? What's the opportunity cost? It's not really black and white. I think if your dad worked with a financial planner and as part of retirement planning projections could figure out what's the value of this and how does that weigh some other things, you'd have a more informed decision from that point.
Awesome job, Jake. We don't have any more questions pending. Like I said, I'm happy to hang out if you guys are happy to hang out, in case people have other ones. I will say, if you have like a detailed personal question, we got a couple of those. I would recommend that you send them to us directly through our websites, because it might not be a good forum to sort of air them publicly here. But if you have any questions about what we presented, we love to talk about this stuff.
Agree, yeah, and I'm happy to stay on for a little bit more too. And again, as Betsy mentioned, when it gets into the weeds of your circumstance and your loan history and other factors that come in, it's really not black and white. I think it really varies for everyone. And that's where getting some help, I think could really make sense.
Speaking of help, someone just said, I asked a question earlier. It looks like a professional would best help me. How do I look for one? Well, what I would say is to start is if your question is about student loans, email us at freestudentloanadvice.org. And if it's beyond our ken, then we'll try to send you in the right direction. If your question is about financial planning, then I would reach out to Jake directly through his website. And if it's beyond his ken, then he will send you in the right direction.
Yeah, and there's another resource in here too, fbama.org. So if you're looking for a financial planner that can specialize there too, that's a great fit too. As Betsy mentioned, if it's just student loan related, she's a fantastic resource. If you want to figure out how do these student loans integrate with your life and your investments and your cash flow and all that fun stuff, that's where me or another financial planner can be the best fit for you. But I always say, I want to make sure you're the best possible fit, the best possible advice too. So if I feel like it's outside of my realm of expertise or not what I focus in on, I know a network of folks that I could connect you with as well.
And if you want to keep up with what's going on with the pandemic, whether it's about your student loans or if you're someone who's about to start college or in college, we've partnered with another nonprofit called Mapping Your Future and created studentaidpandemic.org. And we're going to keep that up for as long as the pandemic is affecting people economically. So probably for a while. So that's another good place to get information.
It looks like our questions are slowing down. I did pop up that exit poll for folks who were here from the beginning where I just asking for some feedback right before you go. It's only like 4 questions. So while people are doing that, I'm going to say thank you to our awesome presenters today. It seems like this is a really good topic. Everybody's really engaged. So thank you for all that you have done and given us. Again, those websites, Jake's website and Betsy's websites, are all in the chat along with those other links that was mentioned today. Just a reminder, you have the next 30 seconds to go into that registration page if you haven't already, to make sure that you get all these websites and links and the recording of our talk to your inboxes. Thank you, and have a wonderful rest of your Tuesday, everybody.
Thanks for having us.
Thanks, everybody.